Businesses have coupons that are going to develop in the future too. If we could see in it, looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out. Not by selling it to somebody else, because that's just a game of who beats who, but by, in a sense, by what the asset itself produces.